Cash balance plan tax strategy. This is an advanced tax strategy, one of the more aggressive ones to put away towards retirement and get a tax deduction for it. It's an amazing tax strategy for a specific type of client. So today I'm going to break down what exactly that strategy is. Hi, my name is Kevin Andrade. I'm a CPA licensed in the state of Maryland. I have over a decade of accounting experience. I run my own tax advisory firm here in Frederick, Maryland, and we help clients nationwide. And my goal really is to help continuously change the game when it comes to the tax industry. No longer just filing tax preparation. I'm really looking to change the game with proactive tax planning for my clients and saving them significant amount on their tax bill while being compliant, right? So that's my spiel. Going back to the topic, cash balance plan tax strategy. And it's almost like a 401k, a supercharged 401k, right? And at the same time, it's a tax deduction. So what I mean by that is this strategy is, spoiler alert, for business owners. It's for business owners, or even if you're a W-2. I've seen some medical professionals who have a W-2 income, and they actually make a significant amount of side income or contractor income, self-employed income via a 1099. And so this could work in that scenario as well. But the strategy is mainly utilized for self-employed income, aka business owners. And then you're able to contribute hundreds of thousands of dollars into this plan, into a retirement plan, while receiving a full tax deduction and minimizing your tax liability. So rather than giving it to Uncle Sam, you're actually going to invest it within this cash balance plan. And so what I'm going to do is now share my screen, and so we can kind of walk through, dive deeper a little bit more into the cash balance plan. Let's see if it works. And feel free to subscribe to our YouTube channel. Once we get up to 1,000 subscribers, I'm going to start doing live Q&A. So look forward to that. So if you enjoy this content, please like this video and subscribe for future content. So here we have our little whiteboard. And so we're talking about the cash balance plan strategy. And effectively, it's employer funded. So it's going to be funded by the actual business to retirements in a defined contribution, kind of like in a pension type scenario with defined retirement benefits. So that's essentially how it works. You know, back in the day, 50 years ago, when everyone get a pension, now they moved away from pensions because the whole purpose of a pension was to keep someone, loyal to the company for 20, 40 plus years, and so they don't have to change employer. The pension kind of gave that peace of mind. But nowadays, pensions are long gone in this scenario. They're no longer offered into your traditional employer. You may see some government pensions still out there, but for the regular corporate job, they realize, hey, people just will work without a pension, and so that's why they got away with it. Big mistake, my opinion. But I advocate for the small business owner. So what the cash balance plan is pretty much kind of like a pension, right? In the sense of that you have to have set contributions. There is a formula that's calculated for the pension, and you have to consistently, and please pardon my horrendous handwriting. I'm an accountant, not a yeah. You have to consistently contribute, right? Consistently contribute to the plan. And so it works well with business owners, professional firms, and high income earners. It can be layered with a 401k to maximize the benefits. And so really you have participants, okay? And there's an amount that's calculated on the annual contribution for these participants, okay? Now, this is a big disclaimer. This is a big deal when you have a lot of cash flow and you're pretty much a solo shop, right? It's just you, you're 100% owner, let's say, of your S Corp. And you have a lot of cash flow. I'm talking about a couple $100,000. You've already maxed out your 401k, maxed out 401k, and looking to look into a more advanced retirement strategy. This is a perfect scenario, the perfect scenario to consider a cash balance plan. Okay. Where it gets a little bit trickier is when you have employees. So when you have employees, you can still do a cash balance plan, but you have to also include the employees into now the benefits. And honestly, as we talked about before, pensions were given back in the day for loyalty, for, hey, you are working in my company, I'm going to reward you with a pension, right? That was honestly, I think, very ethical. Now these pensions are long gone, or there's been fraud cases that there's actually nothing when people retire. That's a whole nother issue. The initial concept of the pension, I think, was phenomenal, right? Um, Again, my personal opinion, you can roast me in the comments, that's fine. So in a cash balance plan, if you have employees, you have to include them in the plan. So that means they're going to get a cut. You have to annually contribute to their plan. The employer portion, right? Whatever that amount will be. And that's not necessarily a bad thing. Why? Number one, it's a tax deduction for you. And number two, employee benefits. What employee is going to say no to that? They're going to absolutely be ecstatic. And if they're a phenomenal employee, if you have great employees, a great team, this is just another icing on the cake to just reward your employees for a good job well done, right? Cash balance plan is one of those things that you can do, right? So it helps you as a business owner to, really get that supercharged 401k, aka, some sort of form of a pension, so cash balance plan, and you get the reward of keeping quality talent. And so that's really the main overview of the strategy. How it works is you have to contribute. Again, there's this whole formula that's done and is done by an actuary. So yes, you cannot do this by yourself. You cannot go to Charles Schwab or E-Trade or Morgan Stanley and try to do this by yourself. You need a legitimate actuary. We have strategic partners within our firm that help us set this up for our clients, right? And so what they're going to do is determine what your contribution should be. This is per participant. And they're going to look at several factors. They're going to look at your age, where you currently are away from retirement, right? They're going to look at your salary, what your current salary is, because it needs to increase. So for example, let's say you want to contribute $140,000 to your cash balance plan, but your salary is only 50K. So you would have, this obviously is not going to work. You would have to increase your W-2 to account for this pre-tax deduction. Okay, but anyways, don't want to get too technical. I already went to, maybe I shouldn't have said that. But so look at your per participant, your age, your salary, and they're also going to look at your actuarial limits. Again, this is why it's so important to work with a legitimate professional. And then the amounts that you can contribute as a business owner, contribution is from 100,000 to 300,000 plus per year. And guess what? This baby is a tax deduction, and it's going to reduce your taxable income, which ultimately, no, this is a tax deduction, which is great, reduces your taxable income and reduces your taxes. Win, win, win. Fantastic. Love it. Anything that reduces taxes, I'm all game for. So the contributions are deductible as a business expense, and you have your current year taxable income that's been reduced significantly, right? And then for the employee portion, you receive annual contributions, interest credits, and then you benefit from transparency and portability if they change jobs. So that's one of the questions that's consistently asked, like, oh, what happens I'm contributing to this plan for my employees. Well, you're doing it in good faith and you're doing it to keep your employees. But in the event that, people, there's turnover, that's reality. People leave. Um, there is the benefit of them to take it with them. That's my understanding. I would actually defer that question to the actuary, to the expert. There's maybe ways to properly design it, right? So step number one, if this is something of interest to you, I would say get with a tax advisor. I was going to put planner. I do tax planning. Get with the tax advisor. Step one, you need to know if you qualify. You need to know if this makes sense. Now, even because you can qualify, but does it make sense? It may not make sense. Maybe there's stronger strategies out there, or maybe this is legitimately like, hey, yes, absolutely, this is a no-brainer. We should do it, right? And we personally, what we do is we do a tax assessment. And that's our step one tax assessment. Similar to a doctor, a cardiologist, right? Or a neurosurgeon, have patients that have issues, much more complicated issues. Uh, you just don't show up at the hospital in a surgery day one. What they want to do is run labs, want to look at your medical history, they want to look at MRIs, CAT scans, all that good stuff. They do to analyze where you are. They ask you a bunch of questions, about your medical history and everything that's going on with your symptoms, etc. We operate in a similar fashion, and we call it the tax assessment. Okay, this is where we get your tax returns. We are going to review your financials. We're going to review um, we're gonna onboard you. We're gonna have an onboarding call. We're gonna do a deep dive into your finances, your goals. We look beyond just taxes. For clients that have already gone through this, we look well beyond your tax situation because we like to be the true tax advisor that looks at your overall wealth picture. Um, and we project your tax liability for the year, and most importantly, we identify tax strategies. Right? We identify tax strategies that are for you. For example, this cash balance plan, all bundled up in a nice little customized, tailored to you tax plan. That's the tax assessment. Anyway, step one, get with the tax advisor. All right, you got with your tax advisor. Great, fantastic. Step number two, you're gonna do an initial consultation with an actuary. Okay. And they are going to walk you through. They're going to ask you questions. They're going to analyze your situation, where your contribution would be, what's the maximum, what you have to, if you have employees, how much you have to pay, what are the fees, what type of investments you can make, what are the risks. The risks are very low, to be honest. It's very, very IRS compliant. And then how does it essentially operate? How does it work? The ins and outs, the do's and don'ts. All that's going to be within the consultation with the actuary. Okay. And then what they're going to do in step three is pretty much do a custom plan design based off your needs. Okay. Because you want to meet your goals, make sure the costs, you're going to talk about costs, annual costs, setup costs, all that good stuff, which is a tax deduction for the business, which is fantastic. And then, what are your goals? Not your goals, your employees, if you have any. Optional, if you have any. Then once you say, hey, yep, looks good, let's move forward, they're going to do the census collection. They're going to do some illustrations. They're going to set you up on a plan, like a legitimate plan adoption agreement. Then we get into the funding part. That's really step number five. So you have the compliance pieces here, compliance. Then step number five is going to be funding. And then step number six is really just the ongoing compliance piece of it. Pete, you're probably looking at my whiteboard, being like, "What the fudge is he saying, or is he writing?" That's why I just listen to my voice, ignore my handwriting, and I write as fast like this so I just can get through the content. Because if I actually try to write, it'll take forever. Ongoing compliance. What does that consist of? You have annual forms you have to file. 5,500. This is very important. Very important. Why is that so important? Sometimes there's instances where people set this up, get the cash balance plan, get the funding that ongoing, and then They don't want to pay for the ongoing compliance. This is so critical. If you do not file Form 5500 on time, which is usually due around July, I believe, and if you don't file an extension, you will get hit with the penalty. And this penalty is massive. It is thousands of dollars per per almost day. Yeah, it's significant. So making sure that the compliance piece is always super important. So you need to understand what that piece is as well, which our strategic partner walks you through from soup to nuts. They're very, very good. And so Form 5500 is one of those things that's just so critical. I say that it's so important for me to mention that because, I had an unfortunate situation with the client that it just, it was missed, not by us, not by the actuary. It was a completely separate plan. But in the changing of hands of brokerages, it just, was one of those things that was missed, filed, it was untimely filed, and penalties are associated with that. So, and now we have a system to keep track of that, make sure that never happens again for our client, even though if it wasn't on us, it's something that I advocate for my clients now. And we have a robust CRM where we track everything, literally every move you make, every deadline, every due date when it comes to your tax situation. We are, again, a professional tax advisory firm, processes, systems, you name it. Anyways, Form 5500 is one of those things. Make sure that there's proper valuation that's being performed on a periodic basis, and make sure you're compliant with the IRS, right? So those are all the lasting compliance pieces. And that's pretty much the cash balance plan. Honestly, it's fantastic. It's a fantastic strategy. If you're maxing out your 401k and you're looking for something larger in you're a business owner or you're a W-2 with high hundreds of thousands or a couple hundred thousand of side self-employed income, this is a fantastic strategy for you. So I hope you enjoy this content. Again, I know you're probably thinking like, I don't got that money. If you have, it's an advanced tax strategy, right? And once you get to these higher incomes, once you progress in your career, if you're in this position, more money, more problems. When I say more money, more taxes. And that's where we come in, right? This is where we specialize in minimizing that significantly. So if you're paying more than $150,000, $200, $500 million in taxes, please schedule a call the link is in the description below. We'll be happy to have an initial point of clarity call and see how we can best assist you. With that said, thank you for your watching and hope you have a wonderful day. Take care.